Good morning. You're watching The Market right here on ET Now. With me, Aisha Fariri, Anisha Jain, Nikunj Dalmia in the studios. And yesterday we were stuck in a range. Start of the week, about 60 odd points. Didn't quite surpass that 19,800 mark, which has been a struggle of late and a tough resistance at that in any case. The broader markets, once again, they showed significant outperformance. So this morning, while the GIFT Nifty right now is indicating a flat start, it started off with a very, very strong move about an hour or back or so. It was pretty much in tandem with what the globe did. So the good thing is that you've got a strong handover from the global markets. But yeah, I guess we're going to fall prey to the earnings, which is the best trigger that the market can follow.
See, Aisha, the setup is not that bad. And now you may argue back and say that, okay, it was a flat Monday, it was just about okay Friday. But look at the world. I mean, there is a geopolitical tension in the world and financial markets globally. They have just ignored and they've just moved on. So it's not only India, but globally also there is more green than red. So if you frankly ask me, the path of least resistance for market is actually on the higher side rather than on the downside. That is the trade setup. But if one looks at the internals of Indian market, which is what you look at, let's say the premium for Nifty futures, it has suddenly vanished. The positioning of retail and FI in the FNO market, which is the retail in the FNO and institutional in the FNO, it's almost even Steven. So as of now, there is no element of excitement. There is no panic. This is where markets are simply marking time. They are taking each stock as it comes. For example, we saw in case with IT that it was a very stock specific adjustment what happened in the market right now. The landscape is not bad at all. The ingredients in the melting pot are indicating that market has a bullish mix rather than a bearish mix. So even if markets they consolidate here, looking at the bias what currently it has, I think the natural course for direction is that markets are inclined to go higher rather than lower. I mean, if somebody tells you that, okay, I was on a 1 week holiday, I suddenly come back and the headlines which are greeting me are big war and a big tension in geopolitical tension, crude going back to $90 plus, FI selling for 13-14 days on a trot now, not very exciting commentary from Indian IT companies which in a sense make 15-20% of the total weightage. And then if you have to guess the Nifty, then you would actually be guessing a level of 18,500 or even 19,000. Yeah. Where are we? We are at 19,800. So the ability of this market to shrug off bad news and climb the wall of worry, I think is absolutely remarkable.
Yeah, and other than retail and DII, it's only actually FII which are skewed towards short positioning. But both retail as well as DII strongly in favor of longs.
And you know, with FIs, it's always the interplay of what you do in the cash market versus what is happening in the FNO market. It could be hedging, it could be commitment change, it could be, you know, tactical trades, what they have. But the heart of the market, I think, is still with retail. Yeah. It is still with DI. Those are the folks who actually have cash. See, FIs are opportunist. They will invest and they will buy and sell depending on what the global mood is and what the global averages are. Retail is where the flows are strong and DIs is where the commitment is strong. And those folks are not throwing in the towel yet. What I don't like about the market right now, frankly, is that there is just no, even though Nifty is not far away from an all-time high, there is just no inertia. There is just no momentum. There is no just commitment. So markets are feather light. Looking at the technicals, I think that path of course of natural direction is on the higher side. So as markets go higher, commitment levels will come higher. But at 19,800, when we're talking about a breakout, you want slightly more elevated commitment levels, which is missing, frankly, in my book.
And the path of least resistance is on the upside. That's the verdict. But if you look at the FI flows, yes, into India directly, there have been a bit of a dwindling of the FI flows because almost 18 sessions out of 19, we have been seeing an outflow as far as the cash volumes are concerned. But if you look at the kind of data that we are getting from ETFs which are listed in the US, it does seem like that India is leading the emerging market ETF inflows. In fact, if you look at the total assets, they rose by almost $294 billion And if you look at the total breakup as well, the total inflows have happened largely in the stock ETFs, and within that, it's India which is leading the pack. India has actually seen inflows of $132 million. And even if you look at the other net inflow data as well, whether you compare it to the likes of South Korea or Taiwan, or even the other emerging markets like Vietnam, Thailand, China, of course, India stands tall and by a massive margin, Nikunj. So if you look at the verdict in terms of the emerging markets, clearly India comes out as the favorite.
So, Anisha, look, I mean, this is something which is yesterday's data, but it will be tomorrow's trend. When I say it is yesterday's data, which is that, the way Indian markets are getting lion's share of inflows, both for non-India dedicated and India dedicated, I think it is important for us to, flag it off. But if this is yesterday's data, then what could be tomorrow's trend? Well, tomorrow's trend really could be that typically when ETF flows, they come back, they will go back into heavyweights. So if ETF flows, they come back, are we in that phase where one last hurrah before the year ends will happen in HDFC Bank or in ITC or in Reliance? Because typically what you actually see is that ETF always is a weightage stroke, a country denominated flow, which normally moves into large cap stocks. The interesting bit for me is that, and just stay with this guys, is that Saudi Arabia has got net outflows when crude has gone higher. Right? I mean, you should have thought the other way around. Saudi Arabia would benefit, right? They've got outflows when crude is going higher. I mean, Saudi Arabia is largely Aramco. So Aramco has got outflows. So the world is telling you that, look, nobody is very worried about geopolitical crisis. Crude has moved in a measured manner. It's too small and too myopic to have a financial disruption. Of course, it will have political compulsions. US President Biden, I was reading in the morning, he would be going to Israel. Soon you will see more and more, leaders, they would be now taking sides here and there. So the political narrative, I think, is going to be keeping everyone occupied. But from a financial market standpoint, I think it is time to just move on.
Well, we will move on, but not before reacting to HDFC Bank, and of course the other big heavyweight is Bajaj Finance. It's a bit of a mixed bag, if you ask, from HDFC Bank. While most brokerages are upbeat about the 12% PAT beat, margin gain, of course, they're saying that is going to be the next deliverable. In that sense, the core operating profit was pretty much in line with the street estimates there. Most brokerages are expecting the NII growth to reaccelerate from here onwards. But the question, for 34 months of underperformance that HDFC Bank has had, can the elephant finally dance on this earnings performance?
See, the elephant is getting ready to dance. They have to get the rhythm right. I don't think it's going to be dancing based on these numbers. I think they just have to identify the right tango number or the right salsa number. I look at HDFC Bank very differently now. The room for negative surprise in HDFC Bank is over. So whatever could go wrong in HDFC Bank in terms of liquidity ratios, financials, the merger, challenges, all that is actually behind us. So the negative surprise from HDFC Bank, both in terms of communication, in terms of numbers, in terms of ratios, I think is unlikely to come. Now, that will restrict the downside for HDFC Bank because the negative surprise, for example, came when the analyst meet happened. There was nothing great which came out again in the quarterly update. So even though numbers are unlikely to warrant a big upgrade, and which is what I'm going through in the morning when I'm crossing some of the reports, checking some of the reports, no big upgrades. But from a market standpoint, I think it is reaching a level where valuations are attractive and it is reaching a point where the scope for negative surprise is unlikely. So you pretty much know that if the scope of negative news and number surprise is unlikely, and if the stock has underperformed, then you would like to say that, okay, this is the base at which the stock is just about getting ready. Now, when will the elephant dance? This quarter, next quarter, I don't know. But all I can tell you is that a year from now or 12 months from now, I think we would be using this phrase that HDFC Bank was an elephant which took its time and finally decided to do the tango. It's like, it reminds me exactly like SBI.
Yeah,
For years it did nothing, and then 3-4 quarters numbers came in, everyone said, oh my God, how did we miss it? It is cheap. The same thing is going to happen.
Yeah, it's quite cheap right now, and to put it into context, as you pointed out, the negative seems to be priced in, and there should be only one way, but markets can be irrational at times, and it seems like for HDFC Bank, at least that's the case right now. The stock hasn't been doing anything for the last many months now. But about the outlook, let's listen in what the CFO of the company had to say yesterday.
that is the fine balance, right? We are here for growth, and the market provides enormous opportunity for growth, right? And it's one of the fastest growing economies in the world, and where the consumer credit penetration is in the low 20s. So there is a big runway for growth that we are tapping into. So yes, we are working towards growing, and at the same time in a profitable and a optimized margin, and for which ideally we will get to fund that through the deposit, and that is a journey, right? That is how we have done, and this merger brought in borrowings, debt borrowings, as a one-time merger adjustment that has come in to us, and then over a period of time that we will work through this to see how to replace it. So it is a journey, and it is not one. There are several positives that come with the merger, and we try to work through to say how we build further from a customer relationship and broad-base that growth.
All right, now let's take that story forward. Rahul Malani joins us. Rahul, good morning. Thank you for joining us. We are looking at numbers in the morning. There's no wow, but do you think now one can safely assume that the scope for any more negative surprise from HDFC Bank is unlikely?
So first of all, good morning. You already did write it that the probability from here on is unlikely that any additional bearing factors could come, which could weigh down the earnings trajectory of the merged entity. In terms of NIM's trajectory, also we expect NIMs have been under pressure and came in higher than expected at a lower rate. But we believe that at this point juncture, NIMs have probably bottomed out, and it will improve gradually. But important thing is that the key challenge remains at this point of the cycle is that the higher credit deposit ratio, which is at 107% higher than the industry. And currently we believe that the loan growth is expected to be in low mid-teens in near term, which should normalize that CD ratio gradually. So basically currently the challenge is that the choice is to slow down the growth and focus on improving the liability profile, or to have a gradual improvement but deliver the higher than industry average loan growth. So the key is to decide whatever path is to be taken. And currently we do not have a differentiating factors which earlier we used to have in HDFC Bank, like higher unsecured portion, which and a lower credit cost compared to the peers, like to the likes of the ICICI and Axis, and a temporary weak liability profile also remains a key challenge at this point of time. But over the period, at least over the 12 to 15 months, we should see improvement in all the key metrics, which should result in certainly re-rating of the stock. But we believe that in the next 12 months it will likely to consolidate.
So Rahul, when will HDFC Bank, purely looking at what is happening in the financial sector, when do you think it becomes from a buy to an attractive buy? It was always a buy, but when does it become like a value buy?
See, currently the valuations are very handy. If you look at the things in a current juncture, when the things will turn, valuations are currently reasonable at this point of time. Whatever the circumstances happens, and at present we believe that the decadal loan growth, which were growing at 17 to 18%, would certainly grow at 14 to 15% in next decade. And so valuations have already priced in. So we believe that a gradual build-up in the position should be happened with a long-term view, and we do not see any outperformance in the near term, but we will see outperformance once all the key metrics comes in place, and it has to be because key metrics has to be compared in line with all the competitors. So we right now it does not have any differentiation in terms of key metrics, which is allowing a re-rating in the stock.
And since we have you with us, talk to us about the latest commentary coming in from Jio Financial Services as well, if you have tracked that one, because they're talking about how they are getting into secured lending, salaried employees, self-employed people, D2C kind of model is what they are employing. What is your read-through for the entire financial services sector?
See, cannot comment on the stocks, on the Jio Financial stock, as we do not have a coverage and we have a compliance section on that.
No worries. Thanks so much, Rahul, for joining us today this morning with that quick take as far as HDFC Bank is concerned. But shifting focus as to what the commentary is coming in from across the globe as well, Vinny is standing by to run us through all of that. Hi, Vinny.
Good morning, and let's talk about some commentary that is coming in on inflation terms from the Fed. So Federal Reserve Bank of Philadelphia President Patrick Harker is actually highlighting in terms of how higher interest rate is actually impacting people and first home owners who are trying to buy because of this high interest cost, borrowing cost, that is limiting them in terms of their buying power as well, which is leading to higher home prices. So that is a concern that he is highlighting. Now we also have Fed's Goldsby, who's highlighting in terms of US inflation. This was with an interview with FT. They're highlighting that US inflation slowdown is not a blip. It is undeniable that the slowdown in US inflation is a trend, and furthermore he's highlighting that the recent fall in the inflation isn't just a one-month blip. He's further cautioning against tying forthcoming monetary policy decision to narrow set of data as well. So that is a concern that he's highlighting in terms of the inflation as well. Other than that, Bank of England's chief economist Phil is also highlighting in terms of UK inflation that may require persistent monetary responses. So yes, that indicates that they would be taking some bit of a hike as long as it's required in terms of peak interest rate that may be furthermore in terms of hiking cycle as well. So yes, that's a concern. Inflation is still there, so they may still take interest rate hikes, is what UK's Pill is highlighting as well. Other than that, ECB is also keeping an eye out in terms of what they're highlighting is for the oil price inflation. That is a concern that is there because of the current geopolitical scenarios that is in Israel and Hamas as well, and that is a conflict that they are highlighting. President Christian Lagarde is also highlighting that they are keeping a close eye on this as well. Now ECB's lane is furthermore highlighting in terms of when you look at it, that the actions that they may take furthermore in terms of rate hikes as well. They're saying that economy is pretty stagnant for the rest of 2023, but they will keep interest rates as high as long as they require it to be on the higher side, and they think that inflation will actually return to 2% from 2025. So that's the highlight that is coming in from ECB's lane as well. So this is the key commentary that we have surrounding the global scenario currently.
Okay, we'll leave it at that, Vinny. Although the handover from the global markets surely has been pretty strong, be it US, where you've seen across the board 1 to 1.5% kind of gains, or for that matter, Asia, which is pretty much following the same momentum, especially, Hong Kong. Nikkei is right now holding up a good solid 1%. But the bigger move, while oil prices have softened, has actually been in the crypto markets overnight. They've been on a tizzy. Bitcoin has seen a move almost inching closer to that 30,000 mark. In fact, it touched that in yesterday's session. So 5% move across the cryptocurrency names is what you've seen. But the GIFT Nifty is indicating a quiet start. And Kunal, morning, it was a very quiet session yesterday as well. What are we in store for today?
So good morning, Aisha. It may not be an ordinary session because my sense is, what has actually happened yesterday, the Dow closed at 33,800 mark, which is for the first time above the 200-day moving average. Now, this could be a decisive breakout for the US indices. Over the last 1 month, the Dow was struggling below this long-term average. It tried to come very close. There were intraday breaks, for the index above that 200 DMA. But yesterday was the first session where the index managed to close. So it may not be an ordinary breakout for the global markets. It could probably be a trending breakout for the global major, and I think that could probably have a positive effect across many of the other emerging as well as the rest of the world equity markets. Coming to our markets as well, specifically, we had the stance that the indices are consolidating 19,300 to 350 as a broad support for the index over the near term, 19,800 as a resistance. But my sense is that if we break past about 19,800 mark today, say on closing basis, then I think we could be calling for a breakout as well as a trend breakout for the indices.
Okay, point taken. Nuresh, 19,800 could be that breakout level, but it's been a long time that we have been trying to get out of that range, right? But 19,800 has acted as a big hurdle. Today, it doesn't look like HDFC Bank is going to support it to go higher. What's your take on that 19,800 level?
So the view is on the index will continue to see for the next 2 weeks impact of results from a lot of heavyweights. So one day we could be breaking out, one day we could be back into the range. So the clear view is that we may not break 19,400, 500 as soon. 19,800 will need triggers coming in from results for the next 2 weeks, or unless there is a much sharper move globally. But if you look at everything apart from the heavyweights, there are strong trends building up across the board. So we've seen a lot of names do well in the mid cap and the small cap category. So the viewers' bias is positive. Ideally, we should go and test 20,200, 300, and 19,400, 500 should hold. But there could be some volatility over the next 2 weeks due to results.
Let's talk stocks now then. Naresh, what's on your list?
So looking at names again from the basket of large caps, which are now showing relative strength. So first is a buy on Hero MotoCorp. The stock finally has started showing strength in the last 3-4 sessions. Has spent many months around this 3,000 mark plus minus 100 points. So looks like finally a breakout could be in the making. An initial target price of 3,300, stop loss at 3,100. Second is a buy on Indraprasth Gas. IGL has gone through a phase of sideways consolidation between 430 to 520. Now the range contracted much more in the last few weeks. It's on verge of a trend line breakout above the 480-85 mark. Once that happens, we could test 520 and eventually break 520 as well. A lot of gas-related names have started showing momentum. We've seen MGL make a new 52-week high, GAIL make a new 52-week high. IGL could be next on radar. So an initial target price of 520, stop loss at 470.
Right. Kunal, what about your strategy, stock specific?
So I'll go with the first one, buy on Havells, the stock coming out of a consolidation or a contraction breakout about at 1400 levels. So would aim for targets of 1500, stop us at 1350. And ICICI Pru apparently is a stock which has come back towards a major support. I think from 600 the stock has corrected towards 520. Now closer to 530 levels, which means the risk reward to enter the stock at current levels could be very lucrative. Would go for a contra buy, targets of 560, stop loss at 515.
Okay, Kunal, thanks so much for those stock recommendations. But we have with us Somit in the studio to talk to us about some of the stocks which are going to be in focus. And of course, top of the heap is Jio Financial Services. While of course the Q2 earnings was pretty much a non-event and nobody was watching out for that. But a lot of important read-through coming in for the entire sector, whether for the lenders or even the insurance brokers.
Well, yes, not only the NBFCs but insurance broking like PB Fintech would also remain in focus. And now this is because Jio Financial came out with this presentation. Now this was not expected by the street. But what are the key takeaways that are coming in here? Firstly, they are saying that they're adopting a direct to customer approach, and this will drive the cost efficiencies. They're also looking to develop a unified app. Now this is very similar to what other financial companies are looking to do. Now what they have launched so far, they have launched a personal loan for salaried and self-employed individual, but this has been done currently through the My Jio app and only in the Mumbai region. Now also they have started the consumer durable loan, but only in around 300 stores on pan-India basis. Now do remember that Reliance Retail has around 18,000 stores, and comparing it with Bajaj Finance, obviously it's premature, but just to give a perspective, Bajaj Finance has exposure towards 76 to 77,000 stores across India. Now this is important for PB Fintech because here the company is saying that they have established partnership with 24 insurance companies across life, general and health insurance. Now this will be important for PB Fintech because this is what PB Fintech also does, and competitive intensity might increase going ahead in this sector as well. Now they have also relaunched their saving account and bill payment and also launched the Soundbox. Now this is in pilot stage, but this is also a direct competition coming in for Paytm. Now what they plan to do going forward, they plan to start auto loans, home loans and loans against shares, which means that secured and unsecured, both across all basket, Jio Financial is looking to expand, and this could be a threat to many NBFCs and PB Fintech like insurance broking companies as well.
Okay, now so let's try and put things in context here. The first number from Jio Financial Services, and if their operational income is not there, why the profits have doubled? That's largely because of the investments and the dividend incomes they have. The business has not started for Jio Financial Services, but they've given us a timeline and a thought in terms of where and how are they likely to migrate. So no magical things will happen for Jio Financials. I think if you're taking a view on Jio Financials, it's right now a leap of faith with a promise that they've got a great team, great pedigree, a strong balance sheet, a great network, understanding of data, customer centric focus, and they can do magic. But somewhere in market, you have to really respect the kind of what Mr. Ambani is commanding. I think is extraordinary for a company which right now has no operating business, has a market cap of nearly 1,50,000 crore. That just tells you the word trust and the word respect what markets are giving to Jio Financial Services. I don't think anything magical will happen in the near term, Sumit, in terms of what they're planning to do. The trigger really could be that what happens to the promoter ownership in Jio Financials. In Jio Financials, the promoter ownership, because there was a treasury share, you take that out and you adjust to that, is actually below 50%. Will the promoter be looking at increasing the stake? For me, that I think is more like a near-term trigger which markets would be watching out for rather than the absolute financial numbers. So you cannot look at these numbers with the exception that there is more clarity, more communication, and which may just act as a spring in the stride for Jio Financial Services. Based on these numbers and based on the communication, can it go back to 275? Looks unlikely to me.
Okay, and the other one, Samit, I'm guessing this is the dhamaka earning for the day, CEAT?
Well, yes, definitely the earnings are a beat on all front beats, sales, margins on sales front, it's actually a 5% beat. Margins have come in also ahead of street expectations, and it has expanded by around 225 basis points on a quarterly basis. EBITDA has grown around 18% on a Q-on-Q basis, and it was 23% ahead of what the street was estimating. Now, this is largely on the back of the fact that the benefits of lower raw material prices have continued to realize in the second quarter of FY24 also. But the key questions now still lies for CEAT is that given the fact that crude is now back at 90, earlier when the margins were expanding for CEAT, that was because crude was at around $70 to $80. But now given the fact that crude is at 90, will this expansion in margins or the margin play still benefit CEAT going forward? Well, likely it won't, because crude is back, the raw material prices are going to increase, and the con call is at 4 p.m. today, and that is what the management would suggest in the conference call also. So that's what we need to keep an eye out for in the CEAT earnings, given that numbers are strong but outlook could be weak on the margin front at least.
See, some of the differentiating factor for CEAT could be what happens to two-wheeler sales. I think we underestimate that CEAT in a sense has got a lion market share which also comes from the two-wheeler sales, and the replacement demand seems to be coming back for CEAT. Now historically what margins they've commanded has been a function of competition, has been a function of tires coming from China, and a function of where the competitive landscape was. Given that right now the two-wheeler sales are subdued and EV sales are moving higher and efficiencies are kicking in, can the 14% plus range be the new range for CEAT? If that is the case, then the stock in the near term I think could pleasantly surprise you. And if the management today indicates that okay, the replacement market is reviving and the cheap imports which were coming from China, they've got control, then I will not be surprised that CEAT actually in the near term actually has potential to go higher. The challenge with some of the tire companies is that you still buy a brand, but they are not commanding valuations of a branded company. I mean, today I think tire companies have invested enough, and now you buy a tire brand, you just don't buy a tire. There's a time you would buy a tire, you would not buy a brand. So for this business where the visibility of brand I think is getting bigger and bigger, and I think it's a matter of time markets will start recognizing it, that earlier you would go to a bank, now you go to a bank for an experience. That is a change which market recognized. I think that same thing I think could be at play when it comes to tire industries in the next couple of quarters.
Okay, that's going to be the fight, I guess, next on branding and brand recall rather. But Samit, thanks for flagging off those two stocks. We'll surely put them on our radars. On that note, in fact, we're going to take a very quick break, but come right back. We'll tell you all about the other stocks in focus this Tuesday morning.
Welcome back. Well, the implied open right now is suggesting a bit of a red tick just around that 19,700 mark. Let's see how we start the trading session, because it doesn't look like HDFC Bank will be supporting the sentiment in a big way. In fact, let's discuss that and a lot more stocks with Sanjeev Bhasin, who's joining us on the show. Good morning, Mr. Bhasin. Thanks so much for making time. Let's begin with HDFC Bank itself. There's, of course, one part of the world which believes that, the worst is priced in, the valuations are really comfortable. But then, of course, the stock has underperformed for a long time, and it doesn't look like there was anything in the numbers to fire up a rally.
Yeah, good morning, Anisha. Good morning to you and all the viewers. Yeah, that was what the management guided, that, don't expect fireworks. But if you see on a sequential basis, they are amalgamating such large balance sheets. They are a market cap now in excess of 15 lakh crore. So obviously it will take a few quarters of transition. But look at the CASA growth, the growth on credit, and the deposit base. I think that is telling you that they are the biggest opportunist in the whole country, and growth is very, very much on the anvil. So if you are a slightly longer term view player, then you have to invest in HDFC Bank. It is not because of the valuation or the comfort which you get and the underperformance. But remember, Anisha, there is underperformance for a limited period. I mean, who thought all the PSUs will be re-rated and double and triple? So I'm not talking of a double triple, but I think it is a portfolio pick here, and definitely you should stick to it as a SIP, because these prices may not remain forever. And if we have to go higher, HDFC Bank has to participate. So I think it is very, very reasonably in line with what the management had guided. And definitely, as a disclosure, for some of our high net worth individuals, we are doing a SIP in HDFC Bank. And we think that this is a very opportune time to get into the 7th largest bank in the world.
Okay, that's the take coming in on HDFC Bank. Although looking at the earnings, we may see some bottom-up buying, but maybe not to start off trade with. Kunal, what are the charts reading?
Yeah, I think at 1500 odd levels, the risk reward to enter the stock is quite lucrative. In fact, the pace of selling has stalled or halted for HDFC Bank. Yes, the stock has not participated on the days when the markets have been doing pretty well for itself. But then I think that's the nature of the stock price over the last 2-3 years. We've seen that the stock has remained more stagnant rather than more trending in terms of the price behavior. Now, I think it requires more of a catalyst in terms of a trend to pick up or the momentum to pick up for HDFC Bank. Maybe if not result, then I think if the market gets into a breakout mode, we could probably expect that the stock may get into some sort of momentum. 1580 apparently is the nearest breakout or a resistance point for HDFC Bank. So it's been ambling into this 80 point, 100 point range around the 1500 mark to 1580 range for itself over the last, I think, couple of weeks. If we expect the stock to break past about 1580 levels, that's where we will probably hope that HDFC Bank could find or at least find its mojo back.
Okay, let's see finally when does it find its mojo back, and I stand corrected as far as the Nifty is concerned, because the implied open is suggesting that we're likely to open around that 19,800 mark. So the good handover from the global markets is something which is going to support the sentiment a bit. But Mr. Bhasin, what about the entire two-wheeler space? And let's talk about the ancillaries as well, because despite the volatility in crude prices, CEAT has managed to report a very strong expansion when it comes to their gross margins and EBITDA margins as well. Your take on CEAT and the other tire companies?
Yes, Anisha, and that is where people are, actually missing the bigger picture. I mean, in the last 1 year, Apollo, CEAT, MRF, they more than doubled on the back that SPT rubber prices have softened, China's imports have almost vanished, and locally, if cars are at a 1 year waiting, then the ancillaries have to do well. So you name it, from a Bosch to a Motherson Sumi to a CEAT, which I think the margins are actually superb, but it's also in the price. The stocks are not cheap and they've doubled or tripled. But it's telling you that OEMs are in a very sweet spot. And as long as this Chinese embargo remains, I think we are, most of these companies will do extremely well. Now, of course, like we said, it was 850, 900 at 2000. The comfort of price may not be there. And you may see profit booking because good results are already priced in. But I still think that fundamentally autos are in a very sweet spot. So Maruti, Ashok Leyland, Tata Motor, Hero Moto, Bajaj Auto, these all seem to be in a very sweet spot, and you should be looking for declines. On the OEM, like you said, our top pick continues to be Bosch. We are very, very bullish on the likes of Exide, where the two, it's a duopoly, Exide and Amar Raja, they are gaining more and more traction. And with lead and nickel prices falling, their net margins can be very, very strong.
Sajeev, the first earnings from Jio Financials, what's been your read-through?
So, good morning. Aisha, it will take time. Jio has just been initiated. It is going to be an outperformer. And the mutual fund distribution, the whole gamut of cross-selling is picking up well. And it's got the brand behind it. The stock is an expensive stock. But if you have a 2-year vision, that, like I said, you must add HDFC Bank and Jio purely on the back of pedigree managements and the way forward. India is on the cusp of savings being capitalized into stock market and other instruments, and that financialization is going to be widespread, and the bigger players are definitely going to get a larger share of the cake. But make no mistake, the NBFCs are being an outperformer, and I think that their cost of funds and their diligence compliances are much less than what banks have to do. So Jio is in a sweet spot, only it needs more gestation.
Okay, fair enough. Mr. Vasina, you were earlier quite positive on the likes of Tech Mahindra, Persistent when it comes to the IT pack. Any other name that you like? Especially HCL Tech has been seeing quite a bit of buying from institutional investors. Your take?
Yeah, so Anisha, you took two names, but HCL Tech was top of them as a disclosure. HCL Tech, Tech Mahindra, and Persistent continue to be our three top names. We've added Coforge because we think there is no promoter and it could be a very, very sweet, candidate for some infusion by a large player. But HCL Tech is a no-brainer. I think 1500 is coming by the next year, and that has been the best performing stock, but purely on the back of rise in margins. And it trades at still half the multiple of a TCS. So HCL Tech, Tech Mahindra, and Persistent in that phase, and you can add a Coforge around these levels.
Okay. Kunal, is the worst behind for IT, or is it too soon to say that, and one should be stock specific?
I think the worst is definitely behind the IT, at least looking at the price movement. That doesn't mean that the prices would start to rally immediately. I think these stocks may consolidate a bit more. I think larger cap stocks like TCS, Infosys, looking at the last 2 days of charts, the first gap down for these stocks, and then a mild pickup of price action, slight resistance at the 50-day moving average. There could be slight bit of more selling which could be due for these larger cap IT names. But then when I look at this in the comparison with September 2022 lows, where the stocks were TCS up 3000, Infosys around 1200 mark, I think they are significantly above those major lows for themselves. So I don't expect these stocks to create a fresh low unless there is something completely negative which happens across the globe or for the sector specific. But I think purely looking at the charts in the recent play, I think the worst part for the IT stocks is behind us.
Okay, point taken. But of course, apart from the entire movements that we are seeing in the stock prices, there's a lot of volatility when it comes to the crude prices as well. And as a result of that, the gross refining margins, at least the Singapore GRMs that we track very closely, seem to have crashed. What's the implication back home? Somit is joining us with all of that.
Well, all the oil refiners would remain in focus, that is MRPL, Chennai Petroleum, Indian Oil Corporation, BPCL, HPCL and Reliance Industries. And this is because of the fact that Singapore gross refining margin, which is the Asian benchmark for GRMs, has fallen to around $4 per barrel. Now, the margins are lowest since July 7th. And if you see from the recent peak that we have seen on August 28th of close to $15.4 per barrel, the margins have fallen by nearly 74%. Now, this is because all product prices were down, and the drop in margins could be owing to higher Chinese exports of refined products, Russia easing the fuel export ban, and because of higher refined product inventory in the US market. Now, how does it impact the oil refiners? Now, generally a $1 per barrel drop in gross refining margin impacts MRPL annual EBITDA by around 1,000 odd crore rupees. For Chennai Petro, it lowers their EPS by around 30 odd %. For Indian Oil Corporation, BPCL, HPCL, it decreases their EPS by around 14 to 16%. And for Reliance Industries, their consolidated earnings come down by around 4 to 5% with every $1 per barrel drop in the gross refining margins.
Okay, that's the take coming in on what the GRM uptick would actually mean for OMCs and other oil companies as well. In the meantime, let's just look at the trading texture for yesterday. While Hero MotoCorp had a field day yesterday, you had some of the metal names as well come to the fore. Coal India continues to be on an uptick, and that was the case pretty much with an ONGC, and then Axis Bank as well held out. It was a better day, of course, for the broader end of the market, where names like a GNFC, MCX, NMDC, Motherson Sumi and Aditya Birla Fashions made a dash up in the green. Sanjeev, just wanted to understand, as a strategy, are you stock specific, or is there some market cap categorization as well, wherein the tilt is more towards small and mid caps other than large caps, or vice versa?
So Aisha, actually it's the momentum, and we will keep talking about the rise in yields and so on, but the local flows are now definitely looking towards mid caps and the small caps. And that is why you've seen PSUs, fertilizer and chemical Travancore has hit an all-time high. This stock used to be 30, 35 about 3 years back and nobody wanted to touch it. Same is the case with REC, PFC and NMDC, it's been a star. So it's telling you that ground level iron ore is definitely going to be in demand and this chaos will see commodities do well. So like I said, it's the broader market which is outperforming and making money. Hence, when you see declines, these are the ones which come back very, very fast. Can it continue? There is still a lot of valuation comfort now in large caps. And I would feel that Reliance and HDFC Bank now with pricing in most of the, lukewarm earnings or the prospect of some of the repatriation, they would start to shine. So we have an overweight on Reliance. We think that GRMs, just the sum of part of $10 billion as a valuation for retail, then the rest of the business cannot be at less than 6 lakh crore. And I think that is giving you a chance to get in. We also are very, very bullish on metals because we think the undoing of a lot of the geopolitical risk will see a rise in copper and aluminium. And we think steel prices, there is already talk of an 8% rise in the price of steel locally. That could actually give an impetus to the likes of Tata Steel, Hindalco, which are, part of the index.
Sure, point taken. In fact, let me quickly bring in Naresh as well into the conversation. Naresh, your take on Reliance Industries and, of course, Bajaj Finance, which will come out with its earnings today?
So Reliance has been pretty sideways for quite some time now. So out here, the view is one needs to wait for more price action to see a change of trend. So as of now, we are still stuck at that 2300, 2350 band for the last 3 sessions. For the last 2 weeks, 2300 to 2400. So once we cross 2400, that's the time where we call a short-term reversal. For now, it is more a sideways stock. Same is the case with the HDFC Bank. So very similar for these two heavyweights. Bajaj Finance, on the other hand, has an interesting chart formation. So if you look at Bajaj Finance today, now it closes to 8,000 rupees. The stock was close to 8,000 in July of this year, as well as in, say, October of 2022, came closer to 7,800. And it had peaked out in September to December of 2021, around the 7,800 to 8,000 mark. So it's on track for a breakout going forward. I would expect it to hold 7,700, 7,800 in terms of a reaction to results as such. But structurally, 4 to 5 attempts made around that 8,000 mark. So generally, a resistance gives a breakout after 4 to 5 knocks. So it's been done out here. So I would expect slowly and steadily the stock could actually go towards 8,600 to 9,000 mark.
Okay, that's the take coming in on Bajaj Finance. In fact, on that note, let me take it across to Vamakshi and find out what to pencil in for Bajaj Finance's numbers and what to look out for.
Well, yes, but before we get started for Bajaj Finance, it is important to take note of the results that came in for its housing finance subsidiary, that is Bajaj Housing Finance. Yes, the loan growth was strong at nearly 29% on a year-on-year basis, but the net interest margins have actually seen a contraction of almost 12 basis points on a year-on-year basis, and that was mainly on account of higher borrowing costs. The net profit, however, declined, and that was mainly on account of normalization of taxation. But nevertheless, when we look at the GNPA, that has actually seen a marginal hike of almost 23 basis points on a sequential basis. Now, moving on to the expectations for Bajaj Finance, in the second quarter, we did see the company post an AUM growth of almost 33% on a year-on-year basis. But given the pressure that is expected to come in on the margins front, we are expecting net interest income to grow at nearly 29% on a year-on-year basis, standing at 7,130 odd crores. PPOP, that is pre-provisioning operating profit, given better cost efficiencies, is also expected to see a growth of almost 31% on a year-on-year basis, coming in at 5,850 odd crores. Now, moving on to the net profit, that is seeing an uptick of almost 28% on a year-on-year basis, standing at 3,550 odd crores. Now, largely, yes, the margins are expected to be under pressure, mainly on account of rising cost of funds. In fact, in the first quarter, the management had indicated that they were expecting nearly 10 to 15 basis points of compression in the next 2 quarters. GNPAs are expected to be more or less stable. In fact, when we look at the GNPAs, they were at the lowest level in the company's history in the first quarter. Credit costs are also expected to remain stable for Bajaj Finance. Apart from that, when the con call happens later this evening, we will be keeping an eye out on the kind of commentary that comes in with regard to its growth prospects, the customer addition trajectory as well. It will also be important to monitor some of the commentary that is around the fundraise that the company had approved very recently. Apart from that, commentary on the asset quality given the challenges on the unsecured portfolio will also be another important factor to watch out for. So all in all, a steady, strong quarter is expected from Bajaj Finance this time around.
Okay, shifting focus now to the other two bigwigs from the entire financial services space, and that's HDFC Bank as well as ICICI Bank. A bit of divergent move this year, Nikunj, while ICICI Bank is up almost 6-7%, HDFC Bank has been a massive underperformer, down 6-7% for the year so far. Do you think that's likely to reverse?
Sinisha, before we understand next 3 years, let's take the last 3 years for HDFC Bank, the pre-merger. Post the Chanda Kochar, episode, the HDFC Bank was here and ICICI Bank was here. Now the situation pretty much has reversed, both in terms of outperformance and in terms of opinion. ICICI Bank has come here and HDFC Bank has come down here. There is a very simple matrix in which you look at banks, and I'm going to break it for our viewers. It's price to book and then P multiples. On both account, ICICI Bank now is actually more expensive than HDFC Bank or vice versa. There you go. This is a forward. I don't remember when was the last time this happened. Now, for me, this in a sense is a very important graphic which tells you the story of how the market positioning has changed. Markets in the near term will always reward performance. And the performance has been lacking with HDFC Bank largely because of the merger issues. For ICICI Bank, they're firing full cylinders, and it's been one of the massive turnaround stories of the banking sector per se. But this kind of a discount, I think, is something which is a rarity. Now in 2015, we saw a similar equation where ICICI Bank had almost gone to levels of SBI in terms of the banking business valuation. But if you bought that time, you had comfort of margin of safety and you had comfort of a turnaround. With HDFC Bank, I think it's not turnaround, but I think it is continuity which would be there and attractive valuations. And I don't think, looking at the news flow, anything substantial could go wrong from here. And most of the negative surprises are out. So if you have so my sense is that if you have to choose now between ICICI Bank and HDFC Bank, the vote goes for HDFC Bank. Underperformance, attractive valuations, unlikely negative communication, looking at what our understanding of the business is, and pure weightage in the Nifty is something which cannot be ignored for long, because now it's about 14% weightage. How long? If you're bullish on India, you cannot be bearish on HDFC Bank. Let me put it this way.
Oh, well, yes, that's a key takeaway. If the index has to move, and if you're bullish on India, of course, HDFC Bank is a critical part of that journey. So have to be positive on that. And right now, the preference seems to be tilting more towards HDFC Bank versus ICICI Bank.
Right. In fact, Sajeev, we know your views on HDFC Bank, but if you were to stack up HDFC versus ICICI Bank, you think the risk reward clearly is tilted towards HDFC Bank, given that ICICI Bank already has been a performer?
Well, yeah, that's what the market is all about, rewarding outperformance. And like Nikunj put it, if you want a weight, if you are looking at bullish part of the India market and going back to 20,000, which I'm very sure is coming in the month of October, then HDFC has to perform. Now, ICICI has definitely been a huge outperformer in the banking. But what, Aisha, I would suggest buy the bank Nifty Bs, because the bank Nifty has 6 PSUs and 6 private banks. And if you want to catch a basket, then you're buying HDFC, ICICI and the other top bank. Actually, bank Nifty can be an outperformer. It has been a relative slight underperformer in the recent 1 month, but I would look at that outperformance. So I don't want to let go of ICICI, but I want to also add HDFC Bank, simply because I think ICICI is headed into 4 figures and beyond, and HDFC will follow suit because of the valuation comfort.
Okay. Buy both. That's the call coming in from Sanjeev. In fact, buy the Nifty Bank Bs is what he's suggesting. The other one, of course, and pretty much like an HDFC Bank story, right? Avenue Supermart, Sanjeev, the going doesn't seem to be that great, at least the past few quarters. And this quarter as well, the net profit slipped 9%. The store additions have remained muted. But do you think, it's all baked in the price now for Avenue?
Correct. And Aisha, like I said, the stock has been a relative underperformer after a huge bout of outperformance when it got listed and so on. And it set the cat amongst the pigeons that what is the extent of retail participation and retail growth which India can visualize. Gone are the days of Kirana stores, and you can see that across the board, these type of supermarts are, raking in the customers and footfalls. I think the branch consolidation and the footfalls and the new acquisitions may take some time to plateau, and you could see margins come back. but arguably, I think the next 6 months could arguably be one of the best for consumption. And if we see a plateauing of geopolitical risk, because this is a recession-proof industry, I think this will again regain its mojo. But like we said, the trends and some of the other supermarts, particularly Jio Retail, Reliance Retail is doing extremely well. So I would sum of parts still buy a Reliance over Avenue Supermart.
The P multiple is where you would say that, look, you don't make too much of money if you buy stocks actually at P multiples of 70, 80 plus. Let's look at some of those stocks. If I may use the word expensive P multiple stocks, महंगे share, Asian Paints 2-year move or 3-year move. Actually, 2-year move is more apt for it because 3 years makes it that you'll have to include the COVID swing also. But let's say if you take the 2-year move in Asian Paints, flat. 2-year move in Pidilite, flat. 2-year move in Nestle should be flat. 2-year move in HUL, absolutely flat. Some of these stocks have not, Nestle is 25%, but for me it's underperformance because remember in 2021, you're coming from that COVID bounce. So including that COVID bounce, HUL has given you actually returns which are not even in line with Nifty. Now the same time frame, let's look at Nifty. You need to compare like to like. So let's also compare the 2-year move from the same. Wow. So all the FMCG stocks, with the exception of ITC, have underperformed the Nifty. बसीन साहब ऐसा क्यों हो रहा है?
वो इसलिए है निकुंज जी, आपने दो नाम बोलता हूं जो मैंने स्वॉट किए थे और वो आउट परफॉर्म किया, आईटीसी एक है और गोदरेज कंज्यूमर. बट निकुंज, you know why are you saying that? Because you've seen the big out performance of mid caps and PSUs, and if money had to go there, then risk had to shift from flat or less beta industry like an FMCG, an expensive industry, into the likes of the PSUs, and still they are under-owned. That is why we compare like to like with a PSU basket or the broader mid-cap market. Then these stocks have definitely been a laggard. But that's the beauty of the market. There is enough on the plate for investors, and if you have the long-term vision, then these stocks are created by brand value over years. Nestle, by the way, has given, I think, over 20%, 25%, but it would be one of the best outperformers. 17,000 is close to 24,000, and there is talk of a split and so on. So I think definitely this basket is looking good, and you will have to ignore one more quarter of maybe flat earnings to slightly moderate, but the longer term trend looks good. And in comparison, Nikunj, they are definitely underperformers with the broader market.
Right. Okay, and I wouldn't be surprised if there's as much trivia that comes out if we stack up what the two-wheeler names, Nikunj, for instance, have done. Look at that. Hero MotoCorp, Bajaj Auto. Nothing on Hero Moto.
I mean, just think about it. Hero MotoCorp in last 2 years has given you no return.
Yeah.
Now, the best part, I think, is yet to come. Let's look at TVS in last 2 years. And
no, before that, Bajaj Auto, 45% move, and I think the large part of the move has come in this year.
This year, because exports in a sense have come back. But if Nifty is given 40%, Bajaj Auto is giving you 45%, that's okay. It's not been an exceptional outperformer when it comes to the Nifty. But guys, look at TVS. Hello. 226% for TVS. And that similar time, if you look at Bajaj or Hero MotoCorp, I mean, there is just no return whatsoever. Since we are talking, let's look, iShares also dekh lete hain. I don't remember the numbers, but let's look at iShares also. It must have not done that bad because, this whole cult motorbiking category, iShares has actually done worse than Bajaj Auto. So you live and learn. I thought iShares must have done better. Now let's do Maruti and Tata Motors. And that's where the surprise would come in, my friends. I think that's where the mega surprise should come in. Because Tata Motors, where it was at the peak of COVID crisis versus now, look at the difference. Tata Motors all the way. I think Mahindra and Tata Motors, I don't know which one. I think it should be Tata Motors, right? 2 years. I'll have to guess.
In 2 years, M&M has had I don't know, let's just bring up that chart.
I don't know.
Maybe M&M, I don't know.
Let's see.
I don't know. Kunal would know better in the last 2 years what's performed better.
No, Tata Motors.
Oh my God. Okay,
Tata Motors.
Yeah, actually for M&M, I think it's the the post-COVID recovery which was steeper. Maybe in the last 2 years, it's actually Tata Motors.
So if you stack up
57%.
Yeah, I mean, so how can you take a sectoral view now? I mean, it is getting so stock specific. Imagine you bought India's biggest auto company, thinking that COVID has normalized and people will start going back. You've made no returns. You bought a bet on EV, TVS, you've hit out of the park. You bought Tata Motors, which in a sense was almost going through an existential crisis at peak of COVID because of its debt, has given the most fantastic returns. And Maruti, which was the market leader, has actually given you no returns. So, very
it's the T factor. Tata Motors from PVs and TVS Motors from the two-wheelers. Sanjeev, what are you placing your bets on? Who's going to win the race in the next 2 years?
Ashok Leland. And I think Ashok Leland has been a stellar outperformer, but not as much as what Tata Motor and Mahindra did. Aisha, look, Tata Motor was doing nothing till the beginning of this year. It is just this last 6-8 months that it has really spearheaded itself, all on the back of N. Chandra's philosophy, outlook, and the accent of EVs. But I think Ashok Leland is very well poised, given that it's in defense. You travel by Indigo, all the blue buses are Ashok Leland. You would see their ICE, the intermediate commercial vehicle, that is Ashok Leland. And they are gaining more market share in the passenger vehicle. As a disclosure, Ashok Leland has been in my portfolio since, I think, over 15 years. And I still think that given the depth of the portfolio which they have, they can be a real outperformer. But like you pointed out, it has been TVS, it has been Bajaj, it has been M&M, and it has been Tata Motors which have taken the cake. I still think Ashok Leland can be a huge, beneficiary of all these underlying businesses, infrastructure related, which are doing very, very well.
Sanjeev, on that note, we'll let you go. Ashok Leland, we will track those charts with our chartist in just a bit. But Kunal has been tracking some technicals for the global markets as well. And he's actually observing something on the Dow Jones, which is now back above its 200 DMA. Kunal, over to you. What does it really mean for not just the Dow, the US equity markets, for us as well?
Thank you, Aisha, for that. So it's a very significant kind of a technical observation, because whenever we've seen Dow Jones historically breaking past about the 200 moving average, it actually kickstarts a trend for the Dow Jones, even if it's a short-lived trend or a trend which lasts for almost 2,000 to 3,000 point impact. The last 4 observations are something which I'm enumerating at in the current charts. This is the November 2022 charts for Dow Jones. This blue line, as you can see, is the 200 moving average. And when Dow Jones managed to just trade closer to the 200 moving average, then come back and then give that second leg of a breakout, that's where we saw the Dow Jones starting a strong trend. And from current levels of 30 to 500 mark, the Dow Jones in a matter of less than a month went into a 2,000 point up move to almost 34,500, 600 levels. This was very recently in the month of March, April 2023, where Dow Jones managed to again reconfirm a similar kind of a trend breakout. Second retest of a 200 moving average breakout. It starts off a trend, and the trend for over the very near term lasts for almost 2,000 point up move. Again from 32,200 odd levels to 34,100 approximately for Dow Jones. Very similar kind of a retest for Dow Jones in the month of June. A retest of the 200 moving average, a bit of a volatility over here, and then a very strong uptrend. This was almost a 3,000 point up move, which lasted for almost 1.5 odd month. Now, why is this very significant? Because just yesterday, Dow Jones has managed to reconfirm a breakout. So as you can see, a bit of volatility coming back over here, a second retest of the 200 moving average, and a similar kind of a breakout. So the last 3 instances, as you can see, the Dow Jones has given almost a 2,000 pointer up move on an average. We can expect something similar this time around, and that's why the importance of this 200 moving average breakout for Dow.
Okay, an important level as far as Dow Jones is concerned, and let's see whether this breakout results in another 10% rally or not in the global markets. But Naresh, just wanted your take regarding a couple of counters. Deepak Nitrite is going to be in focus because Axis Capital has actually initiated coverage on that counter with a buy rating. And of course, yesterday the entire fertilizer pack, right from FACT, RCF, GSFC, all of them were flying away in the trading session. What's your top recommendation?
So, firstly, starting with Deepak Nitrite, the stock seems to be getting into a sideways range, although it keeps making a pullback move every a few weeks, but we've seen it fade off. So, over the last 4-5 months, it has tried to climb back from 1950, 2000 to 2350, again pulls back towards the 2000, 2100 mark. So, that would be a stock which would be well avoided. I would expect a sideways range to continue for much longer. From the fertilizer pack, one has to be careful. A lot of these smaller names like FACT have a very low float. So, for example, today FACT is at a market cap higher than Coromandel fertilizer. So, that indicates a lot of speculation going on. But if one has to look at fertilizer pack, one can be looking at something like a Chambal or say a Coromandel itself. Chambal is one which is trying to bottom out, been sideways for the last 1.5 years, and has started making a maze. So out here, 280, 290 could be a good support zone. Chambal could be one interesting one. And on the opposite end is Coromandel International, which is closer to an all-time high and is sustaining at higher levels. So I would avoid the smaller names with the low float in the PAC segment and focus on Chambal and Coromandel.
Okay, point taken. Let's also take some mid-cap ideas from our chartist. Kunal, you go first.
Well, I'll go with one of the other mid-cap names, and that was something which we flagged off recently as well. And that was on NMDC, something which we I think managed to trade almost close to 145, 146 levels. Now the stock is at 160 plus mark. Excellent momentum for the stock. Many of the other peers have also done reasonably well. The stock has confirmed a breakout on higher time frame. So this looks a very attractive chart even at current levels. Would look out for 175 as a target. Stop loss at 160.
Okay, so that's a take. NMDC is one of the stocks that Kunal likes. Naresh, what's on your radar?
So that would be a buy on Ipca Labs with a stop loss at 950 and a target price of 1050. The stock for the last almost 1 year has become sideways. It saw a sharp correction in April, May on the news. Post that, it has made a slow and silent recovery. From May, it went up from 700 to 950. Again, in September, it made a top around 950. Again, in October, it made a top around 950. Yesterday was the day where it started breaking out last 3 sessions. So it's you could call it a cup and handle or inverted head and shoulders pattern. Could see a much larger move also going forward. A good risk reward trade here. Stop loss at 950, target price of 1050.
Okay, so Ipca Labs is one of those top recommendations coming in from Naresh. In the meantime, let's run you through the headlines coming in from across the world in our News Fatafat segment. The war between Israel and Hamas continues unabated, with the total casualties mounting to nearly 4,200. The situation remains grim for the people of Gaza as the Israeli army prepares for an escalated ground invasion. Meanwhile, in an affirmation of US support to Israel, President Joe Biden is likely to visit the war-hit nation tomorrow. Meantime, Russian President Vladimir Putin has arrived in China for his meeting with Chinese Premier Xi Jinping. This is despite an arrest warrant issued against him by the International Criminal Court. Putin is also expected to attend the Belt and Road Forum being organized by China. 2 Swedish nationals were shot dead and a person injured in an attack in Brussels. The Belgium-Sweden Euro 2024 qualifier football match was halted amid the terror alert. The assailant is still at large even as Brussels is on high alert. Meantime, back home, the Supreme Court that will deliver its verdict on the all-important petition seeking legal recognition to same-sex marriages today. The 5-judge bench, led by Chief Justice D.Y. Chandrachud, had reserved its judgment after a 10-day hearing back in May. And the festivities have started. The Navratri celebrations are in full swing with Dandiya and Garba events around the country. Meanwhile, Durga Puja pandals are being given final touches to the elaborate decorations. Footfalls in these pandals go in thousands in the last 5 days of the festival. Moreover, the Ramlila grounds too are decked up for the Dussehra celebrations, which culminates the Navratri and the Puja festivals.
The punchline on Dalal Street, irrespective of whom you meet, it's a very colloquial term, and you say, "Kya khabar hai?" And that's the name of the segment, because Sharad will always tell our viewers in the morning, market mein kya khabar hai. Sharad, over to you.
Well, yes, the focus is Religare Enterprises, and what we are getting buzz from the street is that investor Ashish Dhawan's stake is set to have come near the 4% mark when it comes to Religare Enterprises. Now, as it was already declared in the September shareholding pattern, his stake has increased by 66 basis points to almost 2.32% in Religare Enterprises. And do remember, Ashish Dhawan is the former co-founder of the PE firm Chrysalis Capital. Now, we did dig deep into the company's turnaround, and what Ventura has stated is it has given a target price of almost 471 rupees per share over the next 24 months. And there are certain re-rating triggers going on for the stock, and the stock has been buzzing also recently. And these re-rating triggers, they include the existing verticals of SME lending, broking and affordable housing firing all cylinders. And also there is a new promoter and the new management coming in. Because of that, re-rating is expected. That's what the street believes. And lastly, the major debt restructuring and one-time settlement of its arm Religare Finvest has also been complete. So in focus would be Religare Enterprises.
Okay, point taken. Thanks, Sharad, for that. In the meantime, let's take a look at some of the stocks which are buzzing around in pre-open. Take a look at CIAT. Of course, the volumes are on the lower side, but it's a 14% surge that we are witnessing, at least in the pre-open rates. The margin is something that surprised the street very, very positively. The gross margins around 40% plus levels. The EBITDA margins doubled on a year-on-year basis. Let's try and pull up that stock in the pre-open as to what it's doing, because that stock is suggesting an uptick of almost 13 to 14%. We, of course, have the management lined up. They'll be joining us at 9:30 a.m. just in a matter of next 25 minutes to talk to us about whether this margin performance is sustainable or not. So watching out for that. You also have MMTC, which continues a solid run from yesterday to today as well. Of course, it's a pre-open rate, but 6% higher. KC International is the other one. The order win of 1,300 crores is supporting the sentiment. It seems 5% higher on that one. And then some run-ons on the likes of Karur Vysya, Data Patterns, Latent View, etc. But in the meantime, of course, the biggest talking point today is the result of HDFC Bank and the fact and the question of when the underperformance will kind of reverse. We pose this question, of course, to Nikunj as well, and listen into his take of how HDFC Bank is stacked up versus ICICI Bank right now.
Before we understand next 3 years, let's take the last 3 years for HDFC Bank, the pre-merger. Post the Chanda Kochar episode, the HDFC Bank was here and ICICI Bank was here. Now the situation pretty much has reversed, both in terms of outperformance and in terms of opinion. ICICI Bank has come here and HDFC Bank has come down here. There is a very simple matrix in which you look at banks, and I'm going to break it for our viewers. It's price to book and then P multiples. On both account, ICICI Bank now is actually more expensive than HDFC Bank or vice versa. There you go. This is a forward. I don't remember when was the last time this happened. Now, for me, this in a sense is a very important graphic which tells you the story of how the market positioning has changed. Markets in the near term will always reward performance. And the performance has been lacking with HDFC Bank largely because of the merger issues. For ICICI Bank, they're firing full cylinders, and it's been one of the massive turnaround stories of the banking sector per se. But this kind of a discount, I think, is something which is a rarity. Now in 2015, we saw a similar equation where ICICI Bank had almost gone to levels of SBI in terms of the banking business valuation. But if you bought that time, you had comfort of margin of safety and you had comfort of a turnaround. With HDFC Bank, I think it's not turnaround, but I think it is continuity which would be there and attractive valuations. And I don't think, looking at the news flow, anything substantial could go wrong from here. And most of the negative surprises are out. So if you have so my sense is that if you have to choose now between ICICI Bank and HDFC Bank, the vote goes for HDFC Bank. Underperformance, attractive valuations, unlikely negative communication, looking at what our understanding of the business is. And pure weightage in the Nifty is something which cannot be ignored for long, because now it's about 14% weightage. How long? If you're bullish on India, you cannot be bearish on HDFC Bank. Let me put it this way.
Okay, so that's a take on HDFC Bank versus ICICI Bank. But let's take a look as to what our chartists are projecting the best way forward for the index today in terms of the recommendations. It's a buy coming in from Kunal because he's expecting the rubber from the global markets to actually pan out back home as well. And that's what the Nifty pre-open rates are suggesting as well. But from there as well, Kunal is expecting a buy. But Nuresh is a bit more skittish. He's suggesting a hold recommendation. Moving on to Bank Nifty as well, it's a ditto call coming in. Kunal recommends to add positions while Nuresh is sitting on the sidelines.
Okay, 1,000 Harley Davidson X440 has been sold in 100 dealerships. It's not to change the stock, I can assure you. 4% is what the stock has done in last 1 year. Multiple concerns. Losing market share, exports are not doing well, never had a deep inroad into the premium entry bike, and then on top of that you got now the whole narrative which is completely against rural India, and then inquiries which are happening. They've just been not on the right side of the narrative, if I may say so. 3182. I think Kunal and Naresh, they both yesterday were discussing that enough is enough, and now the stock is getting ready for a breakout. Kunal, you still believe that?
Yeah, very much, Nikunj. I think the stock is now showing all those classical ingredients of a trend shaping up. Earlier there were many false starts for Hero MotoCorp, and I think this time around, hopefully, the charts, the indicators are far more subtle and stable for the stock as what it had been earlier. So this time around, the probability of the stock starting off an uptrend is extremely high as compared to the previous many attempts.
Naresh, would you stick your neck out and say, okay, Hero MotoCorp ka bhi samay aa gaya?
Absolutely. So finally, after weeks and months of consolidation around that 2900, 3000 mark, we are getting a price action which is confirming. Yesterday, it crossed a 2-month high. And now the next level to cross is roughly that 30 to 50 mark, which is where it tried to make a breakout move. And then there was some news, and post that the stock corrected. Ideally, in this case, it could go all the way to 3600, 3800 mark.
So let's look at the 2-year point which we were discussing. We were discussing what is happening to what currently is happening, what has happened to Hero MotoCorp, 4% in last 1 year, TVS 220% in similar time. Maruti up 35-40%. Maruti has actually underperformed the Nifty, and at the same time Tata Motor has given you a return of 225%. That's 52-week. Let's look at even 2-year one. I mean 52-week also the similar divergence would be there, because in last 52 weeks Tata Motor actually has got re-rated multiple times. The point I want to understand, perhaps Naresh and Kunal, and let's make a 2-window here, is last 2 years, if you bought Tata Motors, you've done well. If you bought TVS, you've done well. But next 2 years, could it be a combination of Hero MotoCorp and TVS? Just switch it. Just switch the outperformers and replace it with laggards. Could that be at play? Kunal, Naresh, anyone can answer this.
So I'll take it first. Nikunj, I believe from here on, from the auto pack, I strongly believe Maruti could probably pay a very strong catch up. So now at 10,500, 600 levels, I think this is a stock to watch out for from the auto pack. My sense is that the stock is coming out of a huge resistance and a major time-wise consolidation. So just like maybe a couple of years back, we spot Tata Motors, I would probably sense Maruti could be a stock which could probably give stellar returns going forward.
Naresh?
So Hero MotoCorp could be a surprise, because if we look at it, 2 years the return is not great, but even the last 8 years the return is not great. The stock at first hit 3,000 odd levels back in 2014-15. So it's almost been a very close to a 8-9 year period of zero return. And when stocks come out of such range breakouts, it can take their own time. But when they come out, they tend to surprise on the way up. So we've seen that happen with Mahindra and Mahindra when it used to struggle at that 800, 900 mark, and then it continued to rally. We've seen that happen with the Bajaj Auto, where it continued to struggle at that 4,000 mark in this recovery. Now the stock is 20-25% higher. So I would expect Hero MotoCorp, which is where the risk reward is great and could actually surprise over the next 3-6 months or even 12 months.
1 minute to go, and the first pre-open rates are indicating that we are in for a good start. Now Dow has closed above 200 DMA. The importance of that, well, it's a mother market, S&P Dow. I mean, that is the leadership market. And if Dow, which is the biggest market, if that one is above 200 DMA, it just tells you the underlying appetite for equities. We are discussing geopolitical ripple, but in reality, financial markets have ignored the geopolitical impact, the spike in crude, the rise in volatility, and the collateral damage it will have in terms of where inflation could move. Most of the indicators are under check. Dollar index 106, 10-year. The most sensitive market is the 10-year market. Anytime there is a geopolitical ripple, the 10-year paper will spike up. It's at 4.7. Gold, silver. There is no risk-off moment in gold. Crude is down 2%. So it is the global, factor, or really the global push which could be at play. So eyes down for the first rates. Are we in for another good day of trade? Well, our technical experts have been endorsing that, so it's a good start, and let's look at that. The market breadth, touch wood, phenomenally better than what we've seen. 1:14 is almost like a dream market breadth. You've seen this really when markets are in a very strong, bullish groove. The small cap index adds another percent. Grasim, Axis Bank, Tata Steel, Bajaj Finance, Infosys. Has the elephant started dancing? Well, it's taken the first step in the right direction. You guessed it. No, it's HDFC Bank now. We're changing the definition. It's HDFC Bank post the numbers. 14%, 21 rupees, 14% weightage, 21 rupees higher for HDFC Bank post numbers. Let's look at now Reliance and especially Jio Financials, because the first number of the listed entity are out. Well, operationally there is nothing in the company. So the other income is a function of dividend income and other investments what they have. But it's a neat start. I will not say it's a great start or a subdued start. It's a neat start for Jio Financials and it's a good start for Bajaj Finance as well.
And good start for SIAT as well. That stock is holding with a gain of around 8 to 9%. Ditto can be said for KEC, which is trending high by 5% on account of that 1300 crore order win. Result reaction coming in for ICICI Securities, 4% higher. Bank of Maharashtra, some follow-up moves from yesterday. So 3% gain, Data Patterns, Jamna Auto, Karur Bank. These are some of the other names. SIAT, of course, surprised with that margin performance, and we're seeing a rub-off impact on other tyre companies. Apollo Tyres and MRF, these are the other two counters which are surging in the trading session. You also have Cyient DLM, which is reacting to its earnings, so watch out for that one as well. On the losing side, not many names, to be honest, from the frontline large mid-cap names. It's KPIT Tech, which is a bit under pressure. Emphasis is the other one that we are watching out for. And then, of course, some of those fertilizer names are retreating. So FACT, etc., seeing some consolidation and profit booking. But it's clearly PSU banking space, which is leading from the front. And then metals, that solid rally that we saw for almost 1% yesterday is seeing some build on gains. So names like NMDC, Jindal Stainless, Welspun Corp, Nalco, Hindustan Copper, these are the names which are surging in the trading session.
Let's check in on Bajaj Finance as well ahead of its numbers, and they're looking to acquire the 20% stake in Pennant Technologies. It's an all-cash deal. Although, looking at the base of Bajaj Finance, it's a minuscule one. 267 crore rupees is the fund used. There's also Delta Corp. While, of course, the stock gapped down yesterday itself, but details on the block deals. Bank of America has sold 30 lakh shares, as has Society Generale sold about 13.5 lakh shares. Delta Corp is finally seeing a bit of a bounce. In fact, we're going to be chatting with the management as well in the due course of the show today. So make sure to tune into that particular conversation. But that's pretty much it. This Piramal Pharma, they've launched in vitro bio capabilities at one of their services site. So that's another stock which is going to be in focus. Grasim, wherein the board has approved a 4,000 crore rupee fundraise via rights issue. That stock is holding up 1%. A decent move actually on Piramal Pharma as we speak. And then, of course, let's check in on the high flyers from yesterday. Hero MotoCorp, GNFC, MCX, NMDC. They were all holding up in trade yesterday, as is the case today as well. So not bad actually, Kunal. It's HDFC Bank which is supporting the index.
Yeah, it's a good start for the index. We are back again about the 90,800 mark. So hopefully this, if we sustain about this level throughout the day, then I think it could be a breakout for the index after this consolidation. In terms of the opening trade, I will pick a differentiated name, ACC, something which looks attractive on the charts. The stock is trading above the 50-day moving average, and we've seen many of the cement stocks actually going to a strong recovery. So we'll pick that stock.
Okay, Nuresh, what are the first trades that you're punching in?
So continue like IPCA Labs, the stock is setting up for a breakout above a 950, 960 mark, could head up towards 1050. So like that one.